SEC filings and the forms you need to know. Securities and Exchange Commission. The SEC requires public companies, certain company insiders, and broker-dealers to file periodic financial statements and other disclosures. Finance professionals and investors rely on SEC filings to make informed decisions when evaluating whether to invest in a company. SEC filings can be accessed for free on the Internet. The SEC was created through the Securities Exchange Act of 1934, which was signed into law by President Franklin D. Roosevelt. The act was intended to help restore investor confidence following the stock market crash of 1929. The SEC is an independent government agency tasked with protecting investors, maintaining a fair and orderly market, and facilitating capital formation. The SEC selectively reviews the information it receives to monitor and enhance compliance. Investors study these filings to form a view of a company's performance and activities. Understanding how to read SEC filings can be beneficial to investors as they perform their due diligence. Here are some of the most common forms that companies are required to submit to the SEC. Registration statements. Registration statements provide information about the securities being offered by a company as well as its financial condition. A company preparing to offer securities to the public will file a Form S-1 registration statement with the SEC. Prospectus and any additional information. This mandatory document must be given to any person who is offered to buy the company's securities. The prospectus must provide details about the company's management, business operations, financial health, operational results, risk factors, and other pertinent information. The Securities Act of 1933 mandates that all companies seeking to raise capital for new publicly offered products in the U.S. must file a prospectus with the SEC. The financial statements such as the company's income statement must be audited by an independent certified public accountant. Additional information in the S-1 form. The company may provide any relevant additional information, for example, recent sales of unregistered securities. Why registration statements are important to investors. Registration statements help investors and analysts understand the nature of newly issued shares or bonds that will come to market. The type of information conveyed in these filings includes a description of the issuer's business and assets, a description of the security being offered, the names and bios of the company's key management, and an independently certified copy of the issuer's latest financial statements. Investors look especially to the prospectus, which contains all of the information a potential investor would need to make a quantitative evaluation of a new security's prospects. It will also often contain important qualitative information that can be interpreted by investors as potential red flags. Because the prospectus is a legal declaration and must meet transparency standards, most companies include certain facts and statements to ensure investors aren't misled in any way, although they may choose careful or clever wording to disguise overt red flags. For instance, if the company faces substantial risks, its prospectus might state risks for the company include, but are not limited to, an evolving and unpredictable business model and the management of growth, or, there can be no assurance that the company will be successful in addressing its risks. Failure to do so could have a material adverse effect on the company's business, prospects, financial condition and results of operations. Reading an issuer's registration statements will often be met with flowery legal prose and lengthy cautionary statements that serve to protect the company more than the investor. Yet, it is also the legal nature of these documents that provides investors with candid information about a prospective investment's risks, opportunities, and competitive landscape. When reading a prospectus, make particular note of company-specific or unique information as opposed to broad or blanket statements that could apply to any publicly traded company. Important to note: forward-looking statements in the prospectus are only projections. Therefore, while they use a company's honest and latest estimates, there is no guarantee the company will meet all or even any of its targets for sales and profits. Form 10-K. The Form 10-K is an annual report that provides a comprehensive analysis of the company's financial condition. Though the Form 10-K contains information that overlaps with the company's annual report, the two documents are not the same. Companies must submit this lengthy annual filing within 60 to 90 days of the close of their fiscal year. Form 10-K is comprised of several parts. These include business summary. This describes the company's operations. It would include information about business segments, products and services, subsidiaries, markets, regulatory issues, research and development, competition, and employees, among other details. Management discussion and analysis. This section allows the company to explain its operations and financial results for the past year. Financial statements. The financial statements would include the company's balance sheet, income statement, and cash flow statement. Why Form 10-K is important to investors. The SEC mandates that all public companies file regular 10-Ks to keep investors aware of a company's financial condition and to allow them to have enough information before they buy or sell securities issued by that company. The 10-K can appear overly complex at first glance, complete with tables full of data and figures. However, it is because it is so comprehensive that this filing is key for investors to get a handle on a company's financial position and prospects. A company will file both an annual report and a 10-K report with the SEC. The annual report is a shorter version that often comes with illustrations, glossy pages, a letter from the chair or CEO, and a summary overview of the financials. The 10-K is a longer, more thorough technical document that will have all of the company's financial statements available for fundamental analysis. Fundamental analysis is a common way to evaluate a firm by constructing ratios and other metrics by extracting information from the balance sheet, income statement, and statement of cash flows. For stocks, fundamental analysis looks to revenues, earnings, future growth, return on equity ROE, profit margins, and equity multiples to determine a company's underlying value and potential for future growth. For corporate bonds, liquidity, leverage, and solvency ratios would be appropriate. In addition to the quantitative approach to fundamental analysis, readers of a 10-K should also pay attention to its Item 1, which explains what the company does, who its customers are, and the primary industry in which it operates. Then, look for risk factors such as legal proceedings or statements indicating future changes or volatility. Also, pay attention to any footnotes that are included in the report. These notes will tell you which accounting method a company uses and how it compares to the generally accepted accounting method and industry standards. This information can flag potentially shady accounting practices. Other details mentioned in the footnotes include errors in previous accounting statements, looming legal cases in which the company is involved, and details of any synthetic leases. These disclosures found in the footnotes are of the utmost importance to investors with an interest in the company's operations. Form 10-Q. The Form 10-Q is a truncated version of Form 10-K that is filed quarterly. The form provides a view of the company's ongoing financial condition throughout the year. The Form 10-Q must be filed for the first 3 quarters of the company's fiscal year. The deadline to file is within 40 days from the end of the quarter. Unlike Form 10-K, the financial statements in Form 10-Q are unaudited, and the information required is less detailed. Why Form 10-Q is important to investors. The 10-Q is important since it is updated quarterly, while the more comprehensive 10-K is only filed once a year. This allows investors to update their valuation metrics and financial ratios without as much of a lag. Investors can use the 10-Q to observe any changes that may be taking place within the corporation even before it files its annual report. Some areas of interest to investors that are commonly visible in the 10-Q include changes to working capital and/or accounts receivables, factors affecting a company's inventory, share buybacks, and even any legal risks that a company faces. You can use a close competitor's 10Q as a comparison company to put side by side the company you are considering to see how it's performing on a relative basis. This will give you a broader idea of whether your investment is a strong choice, where its weaknesses are, and how it could stand to improve. Form 8K. The Form 8K is what a company uses to disclose major developments that occur between filings of the Form 10K or Form 10Q. Major company events that would necessitate the filing of a Form 8K include bankruptcies or receiverships, material impairments, completion of acquisition or disposition of assets, or departures or appointments of executives. Why Form 8K is important to investors. Form 8K provides investors with timely notification of significant changes at a company. Many of these changes are defined explicitly by the SEC, such as a merger or acquisition, while others are simply events that firms consider to be sufficiently noteworthy for its shareholders, such as a new product release or upgrade. Either way, the 8K provides a way for firms to communicate directly with investors in a way that is not filtered or altered by media organizations or sell-side analysts. Form 8K also provides a valuable record for financial research and analysis. For example, an analyst may wonder what influence certain corporate events have on stock prices. It is possible to estimate the impact of these events using statistical techniques like regressions, but researchers need reliable data. Because 8K disclosures are legally standardized and must be honest and accurate, they provide a complete record and prevent sample selection bias. Proxy Statement. In the proxy statement, investors can view the salaries of the management of a company and any other perks that a company's management is eligible for. The proxy statement is presented prior to the shareholder meeting and must be filed with the SEC before soliciting a shareholder vote on the election of directors and approval of other corporate actions. Why a proxy statement is important to investors. Public companies hold annual meetings where shareholders convene to vote on various corporate actions or for new members to the board of directors. Owning common stock in a company gives you a vote, usually one vote per share, but it is not typically feasible to attend the annual meeting. The proxy statement allows you to cast your votes using a designated person, who will aggregate votes and cast them on your behalf. This person is known as a proxy and will cast a proxy vote in line with the shareholders' directions as written on their proxy card. Proxy votes may be cast by mail, phone, or online before the cutoff time. This deadline is usually 24 hours before the shareholder meeting commences. Vote responses will typically include for, against, abstain, or not voted. Forms 3, 4, and 5. These forms are filed by corporate insiders. The SEC defines a corporate insider as a company's officers and directors, and any beneficial owners of more than 10% of a class of the company's equity securities registered under Section 12 of the Securities Exchange Act of 1934. These forms are meant to reveal more information about the securities that company insiders own. Form 3. This form is the initial filing and discloses ownership amounts. Form 4. This form identifies changes in ownership. Form 5. This form is an annual summary of Form 4 and includes any information that should have been reported. Why Forms 3, 4, and 5 are important to investors. If you're an investor, it pays to know what the company's owners and most important insider shareholders are doing. By watching the trading activity of corporate insiders and large institutional investors, it's easier to get a sense of a stock's prospects. While insider or institutional ownership on its own is not necessarily a buy or sell signal, it certainly offers a handy first screen in the search for an investment. Since insider ownership and trading can impact share prices, Forms 3, 4, and 5 are useful disclosures. By paying close attention to what insiders do with their company shares, savvy investors can make the reasonable assumption they know a lot more about their company's prospects than the rest of us outsiders. So, if insiders are buying shares in their own companies, They might know something that normal investors do not. The insider might buy because they see great potential, the possibility for merger or acquisition in the future, or simply because they think their stock is undervalued. Note: in some cases, insiders are usually prevented from buying and selling their company stock within a 6-month period following a corporate event or new issue. Therefore, insiders tend to buy stocks when they feel the company will perform well over the long term, or they are forced to buy shares as part of their contract of employment with the company. Also note: you can also have too much insider ownership. When insiders gain corporate control, management may not feel responsible to shareholders and instead try to enrich only themselves. Schedule 13D. The Schedule 13D is also known as the Beneficial Ownership Report, and is required when any owner acquires 5% or more of the voting shares in a company. The report must be filed within 10 days of reaching the 5% threshold. It provides the following information: the acquirer's name, address, and other background information. Type of relationship this owner has with the company. Whether the person has been convicted of a crime in the past 5 years. An explanation of why the transaction is taking place. The type and class of the security. The origin of funds used for the purchase. Why Schedule 13D is important to investors. 13D was added to the Securities Exchange Act of 1934 as part of a 1968 amendment known as the Williams Act. Due to the increasing use of tender offers as part of corporate takeovers, 13D was designed to give investors warning of changes to corporate control that could impact the company, from the voting power by corporate raiders. 13D is used to both detect red flags in the consolidation of insider ownership that can be potentially harmful to shareholders, but also as a possible harbinger of a company being acquired or bought out. Form 144. Form 144 is required when corporate insiders want to dispose of company stock. Form 144 is a notice of the intent to sell restricted stock, typically acquired by insiders or affiliates in a transaction not involving a public offering. The stock is restricted because it must meet certain conditions before becoming transferable. The transaction, or at least part of it, is made within 90 days of filing. Form 144 is required when the amount sold during any 3-month period exceeds 5,000 shares or $50,000. Why Form 144 is important to investors. While investors can look to Forms 3, 4, and 5 for changes in insider ownership, Form 144 is useful for knowing how many potential shares will be offered for sale on the open market after the lockup period for a new issue, such as an IPO or initial public offering. Form 144 can indicate how much a stock price might suffer if a flood of new sale orders enter the market when the lockup ends. Underwriters and regulators require that a company's executives, managers, employees, and early investors, such as venture capitalists, sign lockup agreements surrounding a company's initial public offering to encourage an element of stability in the stock's price in the first few months of trading. The lockup agreement is a legally binding contract between company underwriters and insiders that prohibits insiders from selling any shares of stock for a specified period of time. Lockup periods typically last 180 days but can on occasion last for as little as 120 days or as long as 365 days. Foreign investment disclosures. In 2008, the SEC updated disclosure requirements for foreign companies offering securities in the U.S. market. For foreign companies without SEC-registered securities, the rules eliminated the requirement that they submit paper disclosures to the SEC, in favor of allowing them to post disclosures in English on the Internet. In addition, the deadline for foreign companies to submit annual reports was shortened from 6 months to 4 months. Why these disclosures are important to investors. Investors diversify their portfolios geographically, including holdings of securities issued by non-U.S. companies, shares or bonds issued by companies in the developed world to emerging market economies, Shares of foreign companies can be acquired on U.S. exchanges in the form of American Depositary Receipts, or ADR. These offer U.S. investors a way to purchase stock in overseas companies that would not be available otherwise. Foreign firms also benefit, attracting American investors and capital without listing on U.S. stock exchanges. Foreign issuers must file forms with the SEC in a similar fashion to domestic companies to provide investors with accurate and up-to-date information. Form F6, for instance, is a regulatory document that all investment firms must register with the SEC if they wish to offer ADR, while Form F4 supports the registration of securities involving foreign private issuers in connection with exchange offers and business combinations. How do you look up SEC filings? SEC forms are filed through a system known as EDGAR, Electronic Data Gathering, Analysis, and Retrieval System. EDGAR performs automated collection, validation, indexing, acceptance, and forwarding of submissions by companies and others required by law to file forms with the SEC. This information on EDGAR can be found on the SEC website, where you can search through forms as well as familiarize yourself with the system using its EDGAR tutorial. Like, share, subscribe, ring the notification bell, leave a thumbs up. High fives for everyone. And thanks to Investopedia for this regurgitation of their content.